What most insurance agents don't understand about indexed universal life. In this educational video episode, I'm going to address how to structure IUL to become self-insured. Now, I'm surprised how many agents don't even know what I'm talking about when I say self-insured, so get ready to learn. I'm Doug Andrew, and I've been a financial strategist and a retirement planning specialist now for nearly 5 decades, helping people prepare for a comfortable retirement so they will not outlive their money, so that they can accumulate, access, and transfer their money totally income tax free. There's only one vehicle in the Internal Revenue Code that does that in a superior fashion. I've challenged many CPAs and tax attorneys that I teach in advanced continuing education courses. Show me any other financial instrument in the Internal Revenue Code that does that. And they want to know where in the code, and that's why they come to learn about sections 72E, 7702, and 101A. You can learn more about how to accumulate, access, and transfer money tax-free in IUL under those 3 sections of the code, complying with TEFRA, DEFRA, and TAMRA tax citations on this channel. Let me summarize what I mean by self-insuring and how your insurance can actually become cheaper as you get older. Because I'm amazed how many insurance agents do not understand this. They poo-poo universal life and say that thing's going to crash and burn when you're in your 70s and 80s. The cost of the insurance is going to go through the roof. And I go, no, the cost of insurance is nothing after the 12th year on most of mine. They go, what? So let me explain what I'm talking about here. I'm going to use an example that I use in many of these educational videos. I've compared an IUL to a bucket for years. It's a repository where we're going to put money into it. Now, the difference with universal life and whole life insurance was designed on a chassis for death benefit, so that it has guarantees in there, and you have to pay a certain amount of premiums for a certain number of years so that it won't lapse. And those guarantees, which they tout are an advantage, they're actually a detriment to having the policy perform. In other videos, I explained that the best whole life policies that I've ever seen would illustrate maybe 8% dividends, but it took until age 95 before the internal rate of return, cash on cash paid into that whole life policy, equaled 5.9%. Meaning, clear to age 95, if the company credited 8, you were only netting 5.9% cash on cash. Why do I like universal life? Because I've averaged 9.6 and netted 8.6. I can net more than whole life grosses because I structure it correctly. And let me show you what I mean by this. The objective when you take out universal life is for living benefits. That's why E.F. Hutton designed it in the first place, is for living benefits. And a lot of agents don't know how to do this. So here's this bucket, and let's say you're a male age 60, and you want to reposition $500,000 from underperforming or non-performing or volatile assets. Many times I'll use the example of somebody who wants to get $200,000 net after tax out of IRAs or 401ks invested in the market because they're sick and tired of the volatile market. And they don't believe they're going to be in a lower tax bracket when they retire. They want to convert to tax-free. So they come to me and say, Doug, I want to be able to put $200,000 out of these IRAs or 401ks, roll it out over 5 years and put it into this, okay? $200,000. I also have a rental property that I'm sick and tired of being the landlord, taking out the trash, fixing toilets, evicting tenants. It's an albatross around my neck. I want to sell that, and I'm going to realize about $200,000 of equity. I want to put that in here. Okay, there's another $200,000. We're up to $400,000. Any other assets that are underperforming? Yeah, I've got $100,000 sitting over here in banks and credit unions. It's pathetic. I didn't know where else to put it. It's only earning 1%. And I know the current of inflation is coming down at 3, 4, or 5. I'm going backwards. I need to increase liquidity, safety, and rate of return of that. Okay, there's another $100,000. We have $500,000. So this is what is called the guideline single premium. That's the most that this person's going to put in. They can't put in more than that. They don't have to put in that much. This is called the GSP, the guideline single premium. It's a male age 60. I go in, and under the TEFRA and DEFRA tax citations, it tells me that a 60-year-old male who wants to have this 500,000 grow at the best internal rate of return possible, as fast as possible, the minimum death benefit is $1 million. Now, if this were whole life, they'd be required to have more than that, okay? That's why whole life costs more. It can't perform as well. Now, I could buy way more life insurance than $1 million with $500,000 of cash. That's not the objective. I want the least amount of insurance so that this $500,000 will grow faster, bigger, okay? And so $1 million, but do I use the increasing death benefit or the level death benefit? Now, there are some short-sighted, senseless advisors that say, oh, level's the devil. Oh, bless your little heart. You don't even know what you're talking about. If you are going to fund this as fast as TAMRA allows, which means you can put in about 120,000 a year the first year, again, the second year, the third year. It may take you 3 years and 1 day to get most of that in. Maybe the 4 years and 1 day, you finally put in the last 50 grand, but it takes you 4 years and 1 day to get this money in there if you want to create tax-free income. That's the TAMRA tax citation. I can comply within 3 years and 1 day, 4 years and 1 day with universal life. With whole life, it takes 6 years and 1 day or 7 payments, okay? So I can get the money in faster with IUL. But see, I put the money in and I want to use the level death benefit if I'm going to fund this within 5 or 10 years. Now, if I'm in my 20s or 30s and I don't have any lump sums and I'm just setting up an IUL and I'm talking away $500 a month, then I would use the increasing death benefit until when? Until you're finished putting money in, you're finished funding it, and you're going to retire or you're going to stop and let it sit and grow. Then you switch immediately to the level death benefit if you want it to become cheaper as you get older. Let's just go back to this because most of my clients are older people who have the money, okay? So you put in 500 grand and you use the level death benefit, that's $1 million, meaning when I get in $500,000, that qualifies as part of the $1 million if I die. They're only going to pay out $1 million. But see, that means that 500,000 of that $1 million was my own money. It means the insurance company only has a net amount at risk. They're only on the hook for the remaining 500,000 because the first 500,000 was my money that's in there. They're only going to charge me for the 500,000. So in 4 years and 1 day, the insurance company is only charging me for half as much insurance as they did the first year. Is that making some sense? The spigot on the bucket, which is the cost of the insurance that has to be there in order for it to be tax-free, that spigot is already about half the size because the insurance, I'm self-insuring. My cash is now becoming the death benefit, okay? Now, most of the clients that I've helped throughout the years have been averaging 9.62% since 1980. Since 1997, when indexed universal life came out, and by using rebalancing, they've been averaging 11.17, netting 10, meaning that if they get credited 11, the net rate of return retroactive back to day one is 10. If they earn 9.6, they're netting 8.6 after the cost of the insurance. The spigot on the bucket has only been draining out 1% of the gross rate of return retroactive back to day one. But actually, in the later years, it's only draining out 0.1%. If I earn 11, I'm netting 10.9 in that given year. But I always like to go retroactive back to day one. But getting back to this, if I'm earning 9.6, that means my money will double in 7.5 years. That 500,000 will double to $1 million in 7.5 years. That would be by the 12th year in this case. So in 12 years, my cash value on this is now equal to $1 million, which is what the death benefit was. What's the net amount at risk? 0. Okay, the insurance company pays out $1 million if I die. Actually, they pay out $1,050,000. They have to pay out 5% more than my cash if my cash equals the death benefit, the original death benefit. So the net amount at risk is now very, very small because I have self-insured. My cash value has equaled and begins to exceed the death benefit in as soon as 12 years, okay? Why do I need to worry about guarantees on a whole life policy that keep the death benefit in force to age 120 when I'm already self-insured, guaranteed in 12 years, okay? It's ridiculous. They don't know what they don't know. Now, this, as we fill this up, if this doubles to $1 million, Teffer and Differ says the death benefit, if you die, is 5% greater. So they would pay out $1,050,000, but they're only charging you for $50,000 of actual net amount at risk. So the spigot on the bucket now is really, really small. And the cost of that, when you're 12 years older, when you're age 72, the cost of that is minuscule compared to the interest they're crediting you on $1 million. That million's going to double in 7.5 years. If you don't take out money, it's going to double to 2 million. If you die, they'll pay out 2.1 million, but they're only charging you for 5%, 100,000 of actual net amount at risk. The cost of 100,000 of death benefit, when you have 2 million of cash value in there earning interest, 10% growth on 2 million is 200 grand. The cost of 100,000 of insurance doesn't even come close to that. Are you beginning to understand this? This is how you become self-insured. So this is what most insurance agents do not understand. If you want to learn more about how to become self-insured and have your insurance actually get cheaper as you get older, I would recommend you study this book and talk to an IUL specialist who knows what they're doing, okay? Now, I want to gift you a copy of this. This retails on Amazon for $20. It's a 300-page book. It's actually 2 books in one. This side is 200 pages, 14 chapters with all the charts and graphs and explanations of how a properly structured IUL is deemed what I call a laser fund, liquid asset safely earning returns, and how it's a superior vehicle to IRAs or 401ks or whole life insurance for living benefits, okay? Now, if you're a left brain learner, this is the site for you. If you're a right brain learner, you flip it over and read this one. This has about 100 pages, 12 chapters with 62 actual client stories of how IUL can be used for all kinds of goals, such as retirement, working capital for business, college funding, real estate management, emergency funds, pension maximization, all kinds of goals, okay? So if you want to use your right brain or your left brain or your whole brain, claim a free copy of this book. I'll gift you one. Simply go to laserfund, laserfund.com, or click on the link below and contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game, okay? And I'll cover the rest of that cost, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. Now, when you're in there claiming your free copy of this 300-page book, check out if you like to listen and learn or watch and learn. There's audio and video options there too. There's educational webinars we teach on a regular basis. They're free. And you can even schedule an appointment to talk to an IUL specialist that I've trained that will create an illustration for you correctly at no cost or obligation, so you can see how an IUL policy can be structured correctly so that you can become self-insured.